Hello everybody, my name is Elisha Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is going to examine whether we are going to see an end to the US stock market outperformance. Specifically, the US S&P 500 index has outperformed the rest of the world for decades. Has this outperformance finally come to an end? For global equities more broadly, a key question for the second half of the year is whether a record long run of US stock market outperformance will finally end. Through the end of 2022, the S&P 500 index has posted higher returns than the MSCI Europe, Australasia, and Far East, or EFI index. This is a benchmark for developed markets outside the US and Canada. And this outperformance has been 53 consecutive rolling 3-year periods measured quarterly. But financial gravity could pull the US market closer to Earth for the following reasons. Most global ex-US markets continue to feature significantly lower valuations relative to both US equities and their own 15% year averages. You'll note that the other indexes are currently lower than the PE averages, and those averages are lower than the US average. The US average is higher than its current 15-year average. Secondly, the recent earnings growth estimates have been higher for Japan and comparable for developed Europe relative to the S&P 500. And thirdly, a weaker US dollar could enhance global return potential for unhedged US dollar-based investors. Developed ex-US equities as a group are catching up with the US. For the first 5 months of 2023, the MSCI Europe Index outperformed the global market, as measured by the MSCI All Country World Index, by a percentage point. Japan's equity market could be the standout going forward. For the most recent fiscal year, which ended March, a 5% growth in Japanese corporate earnings translated into a hefty 12% rise in earnings per share, thanks to major share buybacks. Further, longer-term factors such as improved corporate governance and capital allocation also bolster the case for Japanese equities, as does the potential for Japanese pension funds to reverse their 25-year pattern of being sellers of Japanese equities. I also maintain a positive view on Chinese equities, despite the country's structural economic issues. Money supply growth in China currently is outstripping real economic growth. Under normal circumstances, that's usually a strong backdrop for financial asset prices. China's slowing and recently negative population, which is a delayed effect of the one-child policy, is also an issue. There are those that can't see China gaining much economic ground and think India is the better bet. But investors need to be mindful of the geopolitical risks, most particularly the potential for Chinese conflict over Taiwan. We can't make the Taiwan tail risk go away. It's probably overstated, but it's there. So based purely on technical price to earnings ratios and their historical averages, the US is overpriced, while the rest of the world is cheap, with lower PEs than the historical averages. So investing outside the US is something to consider, but it's not as clear-cut as one would like. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.